Welcome back to the Blueprints for Better Benefits series. I'm your host, Rodney Matos Jr., and today we're diving into one of the most misunderstood yet most empowering topics in modern benefit strategy: stop loss insurance. Many employers want to explore self funding, but worry about unpredictable claims and catastrophic expenses. Today, we look to change that. At Triforta, we see stop loss as more than a safety net. It's a strategic lever that unlocks transparency, control, and flexibility. Stop loss gives the freedom of self-funding without the fear of runaway financial exposure. We'll break down the specific stop loss, aggregate stop loss, the 125% corridor, and how employers use these tools to stabilize costs year after year. And guiding us is someone who has engineered hundreds of self-funding transitions, Triforta's founder and CEO, Rodney Matos Sr. He'll walk us through the fundamentals, the protections, and the opportunities that stop loss creates. This is Self-Funding 101, Stop Loss Demystified. Let's begin.
All right, we're back. So let's pivot now to one of the most misunderstood yet most powerful tools in your benefit strategy arsenal: stop loss insurance. At Triforta, we see stop loss as more than just an insurance product. It's a strategic lever that empowers employers to embrace self-funding with confidence. But let's be honest, stop loss can sound like a foreign language to many. So let's demystify it together. Here's the essential truth. Self-funding puts you in the driver's seat, giving you the flexibility to design a plan that fits your workforce like a glove. But with that flexibility comes a responsibility of paying claims. And that's where stop loss steps in. Think of stop loss like a financial safety net. It protects your plan from catastrophic claims that could otherwise derail your budget and put your entire benefit strategy at risk. So let's talk about how it works. First, we have specific stop loss. It protects against large unpredictable claims from a single employee or dependent, like a premature baby or complex surgery. Then there's aggregate stop loss. This captures total claims liability for the entire plan, ensuring you never pay more than you can afford. It's like having guardrails on a mountain road, enabling you to navigate the sharp turns of healthcare costs without plunging over the cliff. At Triforta, we go beyond the policy. We partner with you to analyze your risk, model potential claim scenarios, and negotiate the most competitive rates with the right stop loss carriers. That means you get a custom-built stop loss program that aligns with your plan design, your budget, and your risk appetite. There's no cookie-cutter solutions here. In the next segment, we'll show you how we use data, technology, and our deep industry relationships to make stop loss work smarter and help you build a sustainable, predictable, and ultimately more cost-effective benefits program for your business. So let's continue. So here we see a breakdown of companies that are choosing to self-insure, which we believe is often the smarter choice for those employers who qualify. The title says it all. Self-insurance costs less. And as we can see, larger companies, those who can self-insure, typically do. It's not a coincidence that 91% of companies with over 5,000 employees self-insure. These are your Fortune 100 companies and large employers who have the financial flexibility to manage their own healthcare costs instead of relying on traditional, fully insured models. So why do they choose self-insurance? Well, when a company self-insures, it gains the ability to deconstruct the complex layers of insurance and eliminate the hidden costs we've been discussing and we illustrated in our previous segments. This allows employers to cut out the waste associated with fully insured plans and avoid paying into a system that is often driven by profit motives, integrated vendors, and opaque rebate systems that we went through previously. By self-funding, these employers can build a leaner, more transparent system that aligns exactly with their needs. However, as the chart shows, only about 30% of companies with 50 to 199 employees are self-insured. So why the difference? So the hesitation often comes down to perceived risk. Smaller companies worry about their exposure to high-cost claims and potential financial impact if a few high-dollar claims arise. They feel the risk may be too high and prefer the predictability of a fully insured model. But at Triforta, we believe that self-funding can be a viable option for many employers, even those in the mid-sized range. We see self-funding as a way for companies to take control of their healthcare spend to avoid the pitfalls of the fully insured model and to benefit from more direct relationship with healthcare providers and cost data. So now let's talk about what we call the fully insured treadmill and why self-insurance offers a fundamentally different experience. This slide demonstrates how costs typically evolve for fully insured versus self-insured plans over time. On the left side, we see fully insured model. Here's the challenge. When you're fully insured, your renewal rates are always influenced by last year's claims. In fact, it's like last year's rate is just the starting point for the next increase. If you experience a bad year with high claims, you're going to see a steep rate hike at renewal. We sometimes joke that fully insured might be better referred to as fully deferred because you're always paying for past claims. In this example, the client has a tough first year with high claims. The insurer will likely come back with a significant rate increase, citing those high costs. Then, in year two, the client could have a good year, meaning claims were much lower than expected. Maybe the carrier overshot the renewal increase at that previous year. And you might think, hey, this is improvement. It would lead to a rate reduction. Well, but instead of rewarding that performance with a lower rate, the insurer might offer only a smaller increase, citing factors like, medical inflation, rising pharmacy costs, and our network contracts, they all keep going up. So that supposedly justify keeping rates elevated. So even after a good year, you don't get to move backward on costs. As we move to year three, perhaps an average year with moderate claims, things went fairly well in that case. And again, you'd expect that might stabilize rates, but the insurer could still justify another increase, pointing to any claims data or market pressure that support a rise. So over time, this pattern just keeps repeating itself, which means you're essentially locked into a cycle where premiums going up regardless of your actual performance. Now let's look at the other side of the equation, at the self-insured model on the right side. In a self-insured plan, you have far more control and way more flexibility. Say you have a challenging first year with higher than expected claims. In year two, if claims drop and it turns out to be a good year, you actually see the benefit. You don't have a carrier telling you that you need to pay more due to external factors. Instead, you get to retain those savings, allowing you to offset costs when claims are lower. Over time, this structure allows you to manage costs more effectively. You're not consistently penalized for a single bad year, and you can enjoy the financial rewards of a good year. With self-insurance, you're working in a system that lets you take advantage of the fluctuations rather than being locked into an upward and never-ending trajectory. It's a long-term strategy that provides stability and cost control in a way that fully insured plans typically don't. So as you're considering your options, think about how much control you'd like to have over your healthcare expenses. Are you looking for a way to manage costs directly and reap the benefits of those good years? Okay, on this slide, we're breaking down the key components of fully insured and self-insured plans to see where the differences lie and why self-funding can lead to substantial savings. So starting on the left, we have the fully insured model. In the fully insured setup, the total premium you pay includes not only your claims, but also several additional costs. Of course, claims are claims, and you'll have them in both models. However, in a fully insured environment, you're often not receiving the same level of data, insights, and of course, pharmacy rebates, which means you lack the visibility to identify waste or inefficiencies in your healthcare spending. Without these insights, it's harder to implement targeted programs to reduce costs, things like second opinion services for high-cost procedures or strategies for better pricing on imaging or elective surgeries. Beyond claims, you're also paying for administrative expenses. The carrier charges you for essentials like customer service, issuing ID cards, handling claims, and generating documents. This cost is present in both the models, But in a self-insured plan, these administrative expenses tend to be lower because you have more control over selecting more efficient vendors. Another key area is pooling charges, which act like the stop loss insurance you'd have in a self-funded arrangement. In a fully insured model, these are built into the premium. While in self-insurance, you purchase stop loss insurance separately to protect against high-cost claims. Here's where the real difference comes in. In a fully insured plan, you're also paying for the carrier's profit margin. And that's a fixed cost that you don't need to account for in a fully insured model. Instead of paying that profit to the carrier, those funds stay with you as potential savings. And lastly, there's taxes. In a fully insured plan, taxes apply to the entire premium. But in a self-insured arrangement, taxes are only applied to that small portion, which is the stop loss premium. And that is often just 20 or 30% of your overall healthcare spending. This means that self-insurance reduces your tax burden significantly. So to sum it up, in a self-insured model, you retain control over administrative and claims costs, avoid those carrier profit margins, reduce tax exposure, which can translate into substantial savings. And you gain access to data and insights that allow you to identify and mitigate waste, giving you more ways to optimize your healthcare spending. So let's break down the typical cost structure for a self-funded plan. And we'll use again a $2 million annual spend as an example. When we move a fully insured client into a self-funded environment, we aim to create a cost-efficient structure where each component is transparent and fully optimized. First, let's look at administrative costs. This portion, which covers everything from customer service to consulting fees, typically represents around 10% of your total spend. This can vary slightly, sometimes a bit higher or lower, but generally it hovers around that 10% mark. These are the fixed costs for managing the plan and ensuring it operates smoothly. Next, we have stop loss premiums, which account for about 25% of the overall cost. Stop loss insurance protects against high cost claims by covering catastrophic loss at a specific threshold. You also have aggregate stop loss policy, which helps shield against cumulative smaller claims that could add up over that entire year. Together, these premiums offer essential protection, enabling you to manage risk without fully transferring it to a carrier. Finally, the largest slice of the pie, claims. Claims represents about 65% of the spend. These are your underlying claims costs, the core expenses of the healthcare plan. This is where most of your dollars go, and it's where we have the greatest opportunity for cost containment. Our goal is to implement programs and strategies that address this area directly, helping you manage claim costs more effectively by focusing on areas such as preventive care, second opinion services, and negotiated pricing for high-cost treatments. So in summary, in a self-funded model, you have a clear breakdown of where your dollars are going. 65% towards claims, 25% towards stop loss coverage, and around 10% for administrative expenses. This transparency allows us to focus on the areas where we can create the most value, specifically in claims management, where targeted programs can yield significant savings. As we go forward, think about how this cost structure compares to your current plan. Does it provide the transparency that you need to make informed decisions about cost containment? So let's take a quick overview of the deconstructed model. So we see a future where employers gain more control over healthcare costs by moving away from a single bundled carrier. In a fully insured environment, a single insurance carrier handles everything: medical claims, pharmacy benefits, disease management, and more, but often at very high costs. With self-funding, you deconstruct each piece of that fully insured puzzle and deliberately choose partners that best fit your employee population and your organizational goals. So, third-party administrators, a TPA, they handle the claims administration, enrollment, and day-to-day plan management. By selecting a TPA aligned with your culture and cost containment strategies, you gain greater transparency into spending patterns, data that helps you forecast and budget effectively. Then, pharmacy benefit managers. Instead of accepting the carrier's default pharmacy program, we can integrate an independent PBM that is laser focused on managing prescription costs and offering clinically responsible coverage. The PBMs can negotiate better pricing and pass through savings directly, further driving down costs for both employers and employees. Then there's stop loss insurance. One critical safety net of self-funding is stop loss coverage. It protects your organization from catastrophic claims by setting a maximum out-of-pocket exposure. This ensures you're not on the hook for unforeseen high-cost medical events, giving you financial peace of mind. Next, we choose our network options. You get to customize your provider network. Maybe you need a broad carrier-based network or prefer a reference-based pricing approach. Some employers even forge direct contracts with local providers or hospitals for targeted cost savings. This flexibility often results in lower claims costs, more favorable provider arrangements, and better employee satisfaction. Of course, we have plan documentation. A self-funded plan has its own governing plan documents, which details covered services, cost sharing, and unique provisions that you want to offer. As the plan sponsor, you have the freedom to shape benefits that resonate with your workforce without being constrained by a carrier's broad template. Then we have some management programs. By incorporating specialized disease management or wellness programs, you can target chronic conditions that significantly impact healthcare spend for your population. Proactive programs reduce utilization and improve the health outcomes, delivering both employee well-being and cost savings, which increase over time. Another are the ancillary solutions. There's an entire ecosystem of optional add-ons like telemedicine, mental health services, second opinion platforms that can be woven into the self-funded plan. And these enhancements increase overall employee satisfaction and help mitigate claims costs by providing timely, relevant care. All of this, which adds up to greater savings over time. So why this is the future? As healthcare costs rise, the ability to choose best-in-class partners is paramount. Self-funding offers direct cost transparency, data-driven decision-making, and the flexibility to evolve a plan as needs change. We are Triforta, and we believe this deconstructed approach, rebuilding each piece with precision and intention, is the most intelligent way to manage employee benefits today and tomorrow. Let us guide you in assembling the optimal plan for your workforce, one that delivers value, control, and a healthier future for everyone.
This segment is brought to you by the people and platforms that make this show possible. First, Triforta. If you're an employer who's tired of runaway renewals, bloated, fully insured plans, and the feeling that your benefit strategy is working against you instead of for you, then hear us clearly. You do not have to play that game anymore. Help business owners fix broken health insurance. We bring cost containment strategies, self-funded captives, data intelligence, and real-world case studies that routinely save employers 6 and 7 figures without cutting benefits. If you want a benefits plan that actually rewards results, visit Triforta.com and download our blueprints for better benefits. And second, Aperionics. If you run an insurance agency and you're still drowning in manual quoting, data entry, or commission reconciliation, you're leaving more than time on the table. You're leaving money. Aperionics is the automation layer built by insurance people for insurance people. AI quoting for carriers that don't have APIs. Instant policy data extraction, commission statement automation, proposal generation in seconds, not hours. Aperionics reduces operating costs and gives teams their time back so they can work at the top of their license. Learn more at aperionics.com. That's APEIRONIX.com. Triforta and Aperionics, 2 companies, 1 united mission. Fix what's broken, elevate what's possible, and help real people thrive. Now let's get back to the show.
On this slide, we'll walk you through the primary advantages of self-funding. Listed here are 7 key points. Let's look at why so many employers are making the shift to self-insurance. Control over plan design and benefits. Self-funding allows you the flexibility to design a plan that meets the unique needs of your workforce. Unlike fully insured plans, which are bound by state mandates, self-funded plans can operate under one consistent national plan. This is especially beneficial as workforces become more remote and geographically diverse, giving you the ability to offer the same coverage to employees across different states without worrying about variations in state regulations. Then there's lower administrative costs. By self-funding, you typically see lower administrative expenses. Why? Because in a self-insured setup, you're not paying a bundled fee to an insurance carrier that includes their profit margin. You're able to source your own services, often at a lower cost, while avoiding the additional overhead that fully insured carriers apply. Then we have choice of network and vendors. Self-funding opens up the options to select your own network and tailor point solutions to address specific needs within your organization. This flexibility allows you to choose vendors that align with your organization's healthcare goals, whether that's focusing on mental health resources, wellness programs, or specialized care options. And then we have the ability to build claims reserves. Since you're not paying a fixed premium that's gone once it's paid, self-funding allows you to build reserves over time. As your company has good years with fewer claims, these reserves grow, giving you a financial buffer. This reserve can also allow you to gradually increase your stop-loss deductible over time, helping you manage trends and keep rates competitive by taking on more risk as your reserves grow. Then we have the collection of health plan data. With self-insurance, you gain control to more comprehensive data about your health plan's performance. Unlike fully insured plans where carriers provide limited insights and all the data is in some black box somewhere, self-funding allows you to use data analytics tools like Springbucks or Perionics that we use in-house to collect that detailed data. This data empowers you to identify trends, spot inefficiencies, and implement targeted programs that directly address the needs of your employees. Then we have control over cash flow. Instead of paying a large premium up front, self-funding allows you to fund claims as they occur. With about 10% of your costs allocated to administration and approximately 25% to stop-loss coverage, only around 35% of your total spend is fixed. This means you have control over the majority of your expenses, allowing you to manage cash flow more effectively and respond to changes in real time. Then we have reduced premium tax. Lastly, there's that tax advantage. In a fully insured plan, you're paying premium taxes on the entire amount. In a self-insured model, you only pay taxes on that stop-loss premium, which is a fraction of the total cost. This difference can result in significant tax savings. On this slide, we're introducing an essential safety net for self-funded employers, stop-loss insurance. When you self-fund, you're taking on the responsibility to cover your employees' healthcare costs, but you're not alone in managing this risk. Stop-loss insurance is a product designed to provide financial protection for employers by reimbursing them for catastrophic claims that exceed a set threshold. This type of insurance is critical, especially for mid-sized employers, as it safeguards against high, unpredictable cost. Without it, a single large claim could significantly impact your financial stability. And stop-loss insurance ensures that while you're able to take advantage of the benefits of self-funding, you're also protected against the rare but costly claims that might otherwise disrupt your budgeting. This slide focuses on a type of stop-loss insurance called specific stop-loss coverage, which is especially important for managing risk at the individual level. Specific stop-loss coverage protects against high costs from any single individual's claim. Let's look at the example on this slide. Imagine an employer group with 250 employees has chosen a $75,000 specific deductible. One of their employees, John Smith, experiences significant health event such as a heart attack, resulting in total claims of $195,000. Here's how specific stop-loss insurance comes into play. The employer is responsible for the first $75,000 of John's medical expenses. However, because his total claims exceeded that deductible, the stop-loss carrier steps in, pay the employer for the remaining $120,000 that exceeded the deductible. This type of coverage provides peace of mind and financial protection. You're only responsible for covering claims up to the specific deductible, and anything above that is covered by the stop loss carrier, protecting your organization from severe financial strain due to high cost claims. Now, let's visualize how specific stop loss coverage functions across multiple individuals within a plan using a $75,000 deductible as our threshold. Each bar here represents a different claimant or member, and the orange line marks the $75,000 specific deductible limit. As we can see, most claimants fall below the deductible, meaning their claims would be fully covered by the employer up to that amount. However, claimant number 5 has expenses well above that $75,000 mark. In this case, the stop loss coverage would activate to cover costs that exceed the deductible, reducing the employer's financial burden for this high-cost claimant. So this graph clearly illustrates the role of specific stop loss insurance. It allows employers to self-fund while having a predictable level of exposure for each individual's healthcare costs. High claims are rare, but when they do happen, stop loss insurance is there to step in and keep your overall spending manageable. So, when choosing the appropriate specific deductible, there are several key factors to consider. And our underwriters and actuaries go through this at setup with every employer. It's all done on an individual basis. But we start with group size. Generally, smaller groups tend to have lower specific deductibles as they might not have the capacity to absorb large claims. Larger groups, however, can often tolerate higher deductibles since they have a broader base to spread that risk. Then, we get access to historical claims data, and we have that data on past claims. It can help us assess the likelihood of high-cost claims reoccurring in the future. A clean claims history might allow for a higher deductible, while ongoing large claims could suggest keeping the deductible lower. Then each employer is different, and their overall risk tolerance varies. So this speaks to how comfortable the employer is with risk. Some employers may have a high tolerance for risk and be willing to accept a higher deductible, while others may prefer to mitigate that exposure. And it's completely fine either way. Carrier benchmarking. It's helpful to see what other similar-sized companies or industries are doing, but it's essential to remain aware of the carrier's incentives, as they may differ from employers' priorities. Then we use third-party consulting. Using actuarial or underwriting consultants to analyze data objectively can provide more accurate recommendations for these deductible levels. And then cash flow. This is about the employer's ability to handle unexpected expenses. If a company has a strong balance sheet and cash flow, it may be more comfortable with higher deductible, knowing it can handle multiple large claims if they happen to arise. So now let's talk about aggregate stop loss insurance. This is a type of coverage that offers additional protection for employers by setting a maximum limit on the total claims that an employer is liable for in a given policy year. Aggregate stop loss protects against a year where multiple smaller claims accumulate, pushing overall costs beyond expectations, even if no individual claim exceeds the specific deductible. So here's how it works. The aggregate deductible is set at 125% of the expected claims for the group. For example, if a carrier projects $2 million in expected claims for a group, the aggregate attachment point is set at $2.5 million. This means that if total claims exceed $2.5 million, the aggregate stop loss insurance will kick in to cover amounts over that threshold. For employers new to self-funding, there's often a concern about cash flow throughout the year. In these cases, a monthly aggregate accommodation is available to help manage cash flow by comparing claims against the year-to-date maximum each month. This allows the stop loss carrier to step in as soon as claims exceed expectations, providing a safety net and peace of mind on a month-by-month basis. In the industry, we sometimes refer to aggregate stop loss as sleep insurance because it's an extra layer of security that comes at a relatively low cost. For example, if your specific stop loss premium is around $400 per employee per month, the aggregate coverage might add only $7 to $10 per employee per month, making it a cost-effective way to ensure stability in unpredictable claims years. Now, this slide illustrates the role of aggregate claims in the context of a specific deductible. So here we're seeing how individual claims stack up over the year under the $75,000 specific deductible. Claimant by claimant, smaller claims fall under that threshold, meaning they all add up to be covered under the aggregate stop-loss policy. So while each of these individually doesn't exceed the spec deductible, together they create a cumulative liability. This is exactly what aggregate stop-loss umbrella is designed to cover, protecting you from the cumulative financial impact of multiple smaller claims. So this slide introduces the 125% aggregate corridor. The black line represents our expected claims, and the orange line marks the attachment point set at 125% of the expected claims. Ideally, these lines should be parallel, with the attachment point 25% higher than expected claims. Throughout the year, actual claims represented by the gradient line can fluctuate. They might start low due to claims lag and then pick up. With monthly accommodations, if actual claims exceed the attachment point during a month, the stop-loss carrier can step in to fund that excess, reducing the employer's risk. Over the course of the year, if claims settle below the attachment point, any advanced funds can be balanced out, providing ongoing protection against unexpected spikes in claims. So let's wrap this one up and review what we just learned. Self-funding equals control. We showed how deconstructing the carrier bundle hands employers real-time data, cash flow flexibility, and freedom from state-mandated sprawl. Then, stop-loss equals guardrails. Specific caps on one-shot claim. Aggregate sets a firm annual ceiling, which is our sleep insurance. And then cost anatomy. In a transparent self-funded model, every dollar is traceable. 65 cents claims, 25 cents stop-loss, 10 cents towards admin. No hidden carrier margin or premium tax on the whole pie. Then we have strategic levers unlocked. Choose your own TPA, your PBM, networks, disease management tech, and point solutions, each handpicked to fit your workforce's risk and DNA. Main truth here is that insurance should finance care, not the carrier's stock price. With self-funding and smart stop-loss, the savings finally stays on your ledger.
Thank you for joining us for episode 3 of the Blueprints for Better Benefits series. Today we revealed that self-funding is not risky when it's engineered correctly. It's liberating. We explored specific stop-loss, aggregate stop-loss, the 125% corridor, and how these tools protect your plan from unpredictable claims. We showed how self-funding delivers transparency, data access, and true cost control that fully insured plans cannot match. At Triforta, this is our mission. Safeguard what matters most with intelligent design, technology, and a team of teams working beside you. If today's conversation sparked any new ideas, visit triforta.com for more insights, guidance, and next steps. We are Triforta, and we're here for you. See you in the next episode.